What is dollar cost averaging? All you need to know. In a time of uncertainty in the market, which feels like all the time lately, it can be helpful to take a calm and collected approach to savings and investing. I'm not recommending anyone stuff their mattresses with cash, but when the world seems heightened with fear and greed, stress, and silly decision-making, it might be time to scale back and remember that we grow wealth best from a larger perspective and with long-term strategies. One example of one such strategy is dollar cost averaging. What is dollar cost averaging, and why is it a great long-term strategy? Let's talk about it. But first, don't forget to hit that like button, subscribe to our channel, and turn on all notifications so you never miss a show or an update. Now, let's get into it. Dollar cost averaging, also referred to as DCA, is an investment strategy wherein someone invests money in an asset over time at a set price in regular intervals rather than investing a lump sum into that same asset. The best example of dollar cost averaging is an employer 401k plan. The employee sets aside a certain amount of percentage of their paycheck to be invested in a mutual fund or an index fund every pay period. Types of dollar cost averaging investments. You can dollar cost average with pretty much any type of investment: stocks, bonds, mutual funds, index funds, crypto, IRAs, and savings accounts. The sky really is the limit. DCA is just a fancy term for setting aside money every week, every 2 weeks, or once a month that goes to the same account or fund no matter how that account is performing. We use DCA to contrast against lump sum purchases or investments, so it is critical to understand the difference between the two and the pros and cons of each. Benefits of DCA. There are many benefits to dollar cost averaging, and chief among them is mitigating risk. When you dollar cost average, you take your emotions out of the decision. Even if you are brand new to investing and trading, you must know how volatile the stock market can be, especially with newer types of investments like cryptocurrency. When you DCA, you decide that you trust the long-term outlook of a particular asset and that you want to invest in that asset regardless of its ups and downs. Because with most stocks, the price will continue to rise over time, you are almost always going to end up on top with DCA. At some intervals, your purchase price will be lower, and at others, your purchase price will be higher. But over time, your gains will outweigh your losses. This is always true of stocks and funds that track with the S&P 500 index. Note, the S&P 500, also known as the Standard & Poor's 500 Index, is a market capitalization weighted index of 500 leading publicly traded companies in the US. It is regarded as one of the best gauges of the American stock market overall. If you invest in a fund that tracks with the S&P index, you are likely to fare well in the long term, as these companies have shown strong, stable, reliable performance over decades. Another benefit of DCA is that you don't have to come up with a ton of money up front to invest in higher cost stocks and funds. This advantage is great for new investors who want to start growing their wealth but don't have a lot of capital on hand. One final benefit of DCA is that some funds will pay dividends, which means they pay out money at certain intervals for having invested. You can have those dividends automatically used to invest more in your asset and increase your overall contribution, growing your wealth even more. How to get started with DCA. If you have an employer 401k, you are likely already dollar cost averaging. If you have a 401k and you aren't signed up to contribute, sign up as soon as possible. Most employers offer a match system where they will match your contribution dollar for dollar up to a certain amount, and if you're not contributing at least as much as your company matches, you're leaving money on the table. If you don't have a 401k option, you can get a local investment brokerage to help you begin contributing to a mutual fund or index fund using DCA, where they set up a certain contribution each paycheck. Disadvantages to DCA. The goal here is to get involved in assets that are stable and expected to rise over time without having to time the market, but that is also one of the disadvantages. You will not be able to play the market when it burns hot and goes cold. You will not be able to buy when a stock is down and sell when it's up. To be clear, you likely should not be doing that anyway. It's way too stressful and can lead to major losses. It takes a lot of time, like a full-time job, to buy, sell, and trade on market whims. Another disadvantage to DCA could be brokerage fees from making regular purchases at intervals rather than a single purchase fee. But again, you will likely make up the amount you pay in brokerage fees with your overall long-term gains. Just be careful about which broker or brokerage firm you choose. Don't go with one that will price gouge you for every purchase. Shop around and be picky. And that's DCA in a nutshell. Now, before you go, make sure you hit the like button, subscribe to our channel, and turn on all notifications so you don't miss our next show. Happy investing!